Hello, my name is Brian Cheung, and I'm an economics reporter with Yahoo Finance. I'm excited to host a conversation today here at the International Monetary Fund on global financial stability, a hot topic right now with the COVID-19 pandemic continuing to put strains on the global economy. We'll be chatting specifically about the IMF's findings in its freshly updated Global Financial Stability Report. And joining me for this discussion is Tobias Adrian, financial counselor and director of the IMF's Monetary and Capital Markets Department. Hi, Tobias.
Hi, Brian. Good to see you.
And we also have with us Fabio Natalucci. He's the deputy director also of the Monetary and Capital Markets Department. Hi, Fabio.
Hi, Brian. Nice to see you.
So I want to start off with a pretty broad question. I want to direct this towards Tobias. So first of all, are banks prepared for everything that we've been going through right now? We know that banks entered this crisis with stronger capital positions than they did in 2008. That's been noted in the report. But this is a very different crisis, is it not?
Yeah, this is a very severe crisis. In fact, the loss of output that we're observing around the world is worse than the 2008 crisis. We are projecting a contraction of global output of 4.4%, so minus 4.4% growth for the world as a whole. And nearly every country is experiencing negative growth. So that's a very bad outcome. But we looked at the global banking system in great detail, and we conducted stress tests of the global banking system. And in our assessment, even if things are getting worse to some degree, the banks should remain safe globally. Having said that, there are some pockets of weaknesses. There are some countries where banks are weaker. Some of those are banking systems that already had struggles going into the crisis. But overall, globally, the banks are in good shape.
Now, what's interesting is that the IMF did a stress test, and I guess I'll direct this towards Fabio. What's funny, though, is that we're already in a stress scenario. In fact, the Federal Reserve was kind of fumbling around with this. They had to have another stress test submission cycle to account for different types of recoveries here in the United States. What did the IMF model into its stress test, and what were the key findings?
Right. So what we use essentially, we run a stress test using the World Economic Outlook, so the WEO adverse scenario. So deviating away from the baseline. And then we try to see what happens at that point in terms of capital position of banks provisioning. And so in reference to what Tobias called a weak tail of banks, we find that if we run essentially the WEO adverse scenario, we found there is a weak tail of banks of about 13%. Those are banks that are essentially within the minimum regulatory capital requirements of 4.5%. There is differentiation across geography, so we break it down by advanced economies and emerging markets, as well as between GSIBs, so the Global Systemic Important Institution, and non-GSIBs. We found that in terms of distribution of capital, the weaker tail is larger when you look at emerging markets compared to advanced economies, as well as is larger for non-Global Systemic Important Institution. The second step we do then, we look at capital shortfalls. So how far in terms of capital position we are from some broad-based capital requirement that includes some capital buffer. And so if you look at this broad-based definition, we are without mitigation policy, so without accounting for policy that be put in place to mitigate, to cushion the impact of the crisis. We find that the impact, it's in terms of capital shortfall, is about $420 billion. Now, interestingly, once we account for mitigation policies, and so those means government loan guarantees, as well as a number of bank-specific policy in place, including, for example, the prohibition of dividends, measure that have impact in terms of risk-weighting asset, how we measure leverage, as well as usability of buffer. We found that the capital shortfall, in fact, is cut enough. So policy has been put in place, have been effective, to a point that, in fact, would cap the capital shortfall almost in half.
Right. And that's really interesting because I guess with the timing of this report, obviously the annual meetings usually happen around October. At least you were able to kind of factor in policies that have already been put in place. But to ask a bigger picture question, I'll direct this towards Tobias. I mean, regulators around the world have had different approaches from a policy standpoint. And some of the things that Fabio just laid out, things like increasing capital levels in some jurisdictions, they've suspended buybacks and dividends. It's been a mix here in the United States with a suspension on buybacks, but not necessarily on dividends. There's a cap. But there's also other things like temporarily lowering leverage exposure calculations. You can release capital buffers. Are there further actions that the IMF would like to see regulators take as we get through this uncertainty period where there could be a possibility of a second wave?
Yeah, absolutely. We are seeing signs of a second wave in many countries around the world. We don't necessarily expect that to be as dramatic in terms of the economic outfall as the first wave, but still it is a further stress element on the banks. And as Fabio said, we subjected the banks in our stress test to quite a bit further downside risks, and they do seem resilient in the aggregate. Now, as you point out, there's a huge variance of policy steps that have been taken around the world. And those are different in terms of financial sector policies. So these are the regulatory steps that regulators have taken and supervisors have taken around the world. Many countries have imposed payout restrictions. Some of them have also imposed restrictions on bonus payments. There's some variance across jurisdictions about dividend versus share repurchases. And there's also a difference in terms of the expectations of how long these policies are going to last. Secondly, many countries have credit guarantees, but that's not the case in all countries. And then there are various transfer programs, fiscal transfers, as well as lending schemes where central banks are giving preferential loans to those banks that are handing out additional loans and credit to companies or to households. So there's a really a very wide variety of approaches. What we are advising our membership, so the country authorities of our 190 strong membership, is to stick to the regulatory setup. So regulations, so those are the Basel III regulations that have been phased in around the world, including the US. Those have a lot of flexibility to deal with this kind of crisis. So banks can draw down their capital buffers, for example. There is a capital conservation buffer, which is designed to be used in times of crisis. There are various ways in which loans can be restructured so that temporarily there can be some relief to the borrowers, so they don't have to pay interest for some time. This can be up to 1 year, in some jurisdictions even longer. And accounting standards also have these exceptions. So our advice is to stick to the regulatory and the accounting setup and to work with the flexibility within those rules. And most countries are doing that. There are some pockets where we see regulators to actually relax the regulatory framework, so to go outside of the common approach that is used by banking regulators around the world. And in our view, it's better to actually stick to the regulations, use the flexibility, so that everybody is operating on the same level playing field across countries.
Got it. So let's drill down into a specific pocket of financial stability. And I'll direct this question to Fabio, corporate debt. And this is important because the private sector is obviously a major employer, but companies needing to survive were unable to tap the markets at the onset of this crisis, with the appetite for bonds just essentially drying up almost entirely. So where did companies turn globally during the onset of the pandemic? Where did they find financing, and how has that kind of affected where risk has shifted in the financial stability system?
So we have seen clearly the corporate sector has benefited from massive policy support. That has come in different forms, both in central bank cutting interest rate to zero in some cases, below zero in other cases, providing liquidity to the financial system, and also a number of liquidity and credit facilities that have been instrumental in keeping financial markets open. So that has allowed essentially to prevent liquidity pressure the corporates were facing from turning into insolvencies. That it's clear when you look at, for example, the spike in defaults, increasing downgrades that we have seen early in the year, and those have started to decline, particularly in the United States, where they have shot up quite sharply. So what policy has done, again, both monetary policy as well as fiscal policy, they provide essentially a bridge toward recovery, so that this pressure, liquidity pressure, did not turn immediately into insolvency. Now, for large corporates, that's evident in their ability to access capital markets. We have seen access both banking, so quick drawdown in lines of credit wherever available, utilization of fiscal policy measure, but also reopening of capital markets. And that's visible in the sharp increase in corporate bond issuance, record high. It started with investment grade and then slowly trickle down to also sub-investment grade firms. So the last, for example, month of September has been a very strong month for the sub-investment grade segment of the corporate bond market. Now, different jurisdictions, we have seen different dynamics. In the US, we have seen more easing in the corporate bond market, so a switch from bank credit toward corporate bond credit. In other jurisdictions, we haven't seen this switch in the same magnitude. But generally speaking, whether it's bank, whether it's corporate bond market, for larger firms, the market has been open. And again, that has provided a lifeline to avoid a wave of insolvency and bankruptcy. Now, the problem is a little bit deeper when you look, for example, instead of SMEs, right? So firms that have been suffer more are firms that are either smaller, they are non-rated, they have less ability to access capital markets, or what we would call financially constrained firms. Those firms that suffer more, they have less ability to access capital markets, they tend to be more bank dependent, they have less liquidity buffer, thinner equity cushion, and also their revenues is much less diversified than the larger firms. That's the segment of capital market that I think going forward will be important for the fiscal policy to focus on more targeted measure, again, to prevent that liquidity pressure turn into insolvency and broad-based solvency. If they do that, especially for the SME sector, that will be a problem along two lines. One is because in jurisdiction like, for example, the European Union, SMEs account for about 2/3 of employment and about half in the US. But also because their source of credit is primarily the banking sector, a wave of insolvency would impact, and going back to the previous discussion, would have repercussion in terms of the bank profitability, in terms of bank provisioning, creating the feedback between corporate, banks, non-bank financial institutions, and ultimately state and sovereigns that the policy measure have been trying to prevent.
Now, Fabio, you talk about the feedback system into the banking area, I guess, and one interesting space has been leveraged loans. It's very popular with low interest rates even before the COVID-19 pandemic. So collateralized loan obligations tend to absorb that up, but there were questions about whether or not there would be a large wave of defaults that could ripple up into the banking system if there were to be large bankruptcies of these large companies with these massive loans. I guess, how has the IMF assessed leveraged loans globally? And we know that activity dropped sharply in Q2 across the board, but is that good or bad from a financial stability standpoint?
So we have done quite a bit of work on the leveraged finance sector, broadly defined in a number of global financial stability reports, going back to the April report, where we tried to map out an ecosystem for leveraged finance. Also, we've done previous work in the previous report. So in the last year and a half, we've done quite a bit of work. I think the response of the leveraged finance market, so collateralized loan obligation, but more broadly other institutional investors, sometimes it's what you would expect. There's been a deterioration in credit quality. You have seen issuance going down, investor pulling back, widening spreads, particularly for the lower rated tranches, and a deterioration of the credit quality of the underlying loans. I think it's a little bit too early, in my view, to judge at this point the performance. The market, in the end, worked. Now we have seen coming back in terms of the pricing of the tranches. We have seen spread narrowing, some issuance coming back. We have seen loan institutional investors, more broadly speaking, find more interest in this loan because spreads widen quite a bit. The point to keep in mind, though, the caveat, is the market has recovered in part because of policy support. So it's very hard to say what would have been the counterfactual without this unprecedented level of policy support. So the market worked. We have seen pricing of risk deteriorate as you would expect, and then a recovery in line with what we have seen in other markets. Again, with the caveat that the markets, whether directly or indirectly to a rebound in risk appetite, has clearly benefited from policy support at this point. So I think I would suspend judgment and to see how the sector evolves as the recovery continues, or as to be mentioned, if we had a second wave, if the credit quality deteriorates. If you look at where expectations are from the rating agencies for default rates, for example, you got a very wide range, right? So ultimately, it will depend what the pandemic does, what policy measures are put in place, whether there's a need for additional accommodation, and ultimately whether there is trust in the system from a health standpoint and the social distancing measure, and we can get the economy start coming back again.
Well, as Fabio described, everything comes back to policy support. So I'll direct this question over to Tobias. In the corporate debt market specifically, what was interesting was that here in the United States, the Federal Reserve opened up their primary, secondary market corporate credit facilities to try to backstop the bleeding in corporate debt markets. They didn't have to do too much. They only bought a few $1 billion in ETFs in addition to corporate bonds directly. But how important was that, at least for debt financing in the United States? And it's my understanding that that specific facility wasn't necessarily the case for other G7 economies and their central banks. So what kind of differential does that provide there?
Yeah, that's an excellent question. So the low point in markets was on March 23rd, and this is the day when the Federal Reserve announced many of those facilities, and that really shifted market sentiment. You managed, or the Federal Reserve managed, to turn around sentiment and to get confidence back into the marketplace. So even though in the end of the day, as you mentioned, there weren't as many purchases as they could have done, it provided investors and individuals and firms the confidence that there was a backstop, there was a floor under the collapse of prices that we saw happening in March. So it's this backstop of the Fed, which is exactly what central banks were constructed in the first place, right? Back in the 19th century, there were many financial crises, many bank runs, and the Federal Reserve was constructed in order to provide a reserve to the banking system. Of course, today, in the US, markets are very important. About half of credit intermediation in the US is not done by banks, but is done in the marketplace. And so this is why in the US it's particularly important to support markets and not just banks. In other countries, that's a little bit different. For example, in many European countries, 80 to 90% of credit are done through the banks. So there, the support of the banks is relatively more important than the support to the markets. But even in Europe and in other jurisdictions like the UK or Canada, we have seen central banks intervene in broader markets in order to get confidence back. And the end effect of all these policies have been to restore financial conditions to something that is very well functioning relative to the economic shock, right? As I said at the beginning, we're in the midst of a massive economic crisis, yet the financial system is functioning. Corporations can get credit, countries can issue corporate debt and sovereign debt, and even though you have this pandemic and the terrible economic crisis, you don't have a financial crisis right now. You have a functioning financial system in the midst of a terrible pandemic, and that's a huge source of strength. And it is the good policy steps that have been done by banking regulators and by central banks in terms of providing capital and solvency in the banks, and in terms of providing liquidity by the central banks. It's that combination that has sustained the financial system, and that helps it to keep helping the economy. Instead of dragging down economic activity, it's actually supporting economic activity. So that's a big achievement.
And you mentioned sovereign debt right there. Chapter 2 of this Global Financial Stability Report does point out that asset purchase programs like quantitative easing have really become the name of the game for the central bank response to the COVID crisis. Even here in the United States, one of the most liquid markets in the world, the market for US Treasuries, did appear to go a little haywire in the beginning of the pandemic. Now, in other countries, let's say frontier or emerging markets, it does also appear like quantitative easing and asset purchases have helped as well. Are there concerns about debt distress in those countries? And what are the implications if this is a kind of central banking world that we're going to be living in for the next foreseeable future, where asset purchases are such a critical part of monetary policy?
So the G10 economy, so these are the most advanced economies like the US, European countries, Canada, Japan, etc. They have expanded their balance sheets by $7.5 trillion in just 6 months. That's an enormous amount. It's a very, very large amount. We have never seen such a big asset purchase program in the world. And in addition, emerging markets have also conducted their own asset purchase programs, many for the first time in the history. And so the combination of these advanced economy asset purchases like the Federal Reserve, the Fed alone has bought $3 trillion of assets in just 6 months. That in combination with what the emerging markets have done have really eased the financing conditions and have allowed many emerging markets to keep issuing, to keep financing their government needs. And of course, just as in the US, Treasury has borrowed heavily in order to finance the support programs, that's also the case in many emerging markets. So for the higher rated emerging markets, like investment grade emerging markets, the yields that are paid today for those countries are actually lower than the yields that were paid at the beginning of the year. So in the face of a crisis, you have so much easing that funding is available. But of course, that's not the case for all countries. And in particular, we have seen that the hard currency issues of those countries, so those are primarily dollar or euro denominated bonds, those have come back in terms of market liquidity and in terms of investor flows. But the local currency bonds, so those that are issued in domestic currency, they have not come back to the same amount. So there are still some areas of stress. And of course, there are some emerging markets that have been hit particularly hard, and they are struggling in terms of covering their funding needs. And so you do see quite a bit of variety of stress across different countries.
So I want to switch gears to a really important topic, which is covered in Chapter 5 of the GFSR, which is corporate sustainability and more specifically, being mindful of environmental risks. So I'll direct this question towards Fabio. I mean, this is something we've heard the European Central Bank, the Bank of Japan, to some smaller degree, the Federal Reserve talk about. How important is it for monetary authorities, but also fiscal authorities, they're the ones that could really drive a lot of change here, to be aware of climate policies and the benefits of a low carbon economy?
So what the chapter does essentially is tries to look back at previous episode of stress, whether this is financial stress, you can proxy it by, say, the VIX, for example, or whether you could look at output gap, how deep the recession was, and trying to get a sense what has been historically the impact of either financial or economic downturn on the environmental performance of firms. And that the lesson there would be, what lesson can we learn in some sense as we think about the recovery going forward? What the chapter finds is that the environment is a risk, essentially, that the environmental performance of firms may suffer through the COVID crisis. That is particularly true for specific firms like those are either smaller, non-rated, that they don't issue dividends, so they are more financially constrained firms. And those firms are also the same, they are less likely to invest in green projects. And so the recommendation out of this is that because we are facing this kind of shock, if we want to move into a recovery that is greener, smarter, more inclusive, there has to be a need for investment policies, climate policies that actually incentivize also the development of sustainable finance. So issues like taxonomies, having global standard, having more disclosure. That will help develop the sustainable finance market that will provide a leg to the recovery, again, trying to make the recovery greener, smarter, and more inclusive. Now, if you step back and make the picture broader, though, climate risk, obviously, there's a number of issues related to climate risk. We had one chapter in April of the Financial Stability Report that focused on physical risk and trying to get a sense how much is priced in the equity markets. And the message there was that probably investors need to pay more attention to physical risk. The other piece is the transition risk. As we transition through the new equilibrium, what will be the impact of climate risk? And there's a number of policy implications. One is what I described in terms of like investment in green investment, use on carbon taxes, for example, or fostering the development of sustainable market. And then there is the aspect for financial institutions, the extent to which climate stress tests, for example, should be incorporated in what central bank does. The IMF can do its part, including those, for example, into the FSAP, which is part of the assessment the IMF does of member countries.
All right. Well, we're running up against time, so I'm going to ask one final question. Tobias, you could tackle it first, and then Fabio, you jump right in right after. But again, we're in the midst of a pandemic. Global financial stability appears to be okay and holding up based off of this conversation so far. But Tobias, what worries you the most right now?
A big worry for us is premature withdrawal of policy support. As we have discussed in the past half hour or so, the policy support is really what has been crucial for the banks, for corporations, and for individuals. It has been very aggressive and very effective so far. In our assessment, economies continue to need that kind of policy support in order to get out of this pandemic without incurring too much economic damage. This is the time when policies are needed, and this concerns central bank policies as well as fiscal policies and a host of support and measures. And so if those policies were to be withdrawn prematurely, that could create lasting economic damage. On the other hand, if these policies are put in place, the support is put in place, then we can come out of the pandemic with an economic structure that is relatively intact and that can go back to, close to levels pre-crisis. So what we worry about is that there's scarring, which is going to generate losses that are going to drag into the future. So to minimize the scarring, policy support is needed today until this pandemic is in check. And from what I hear, there's very good hope that next year we will see a turnaround on the pandemic side.
All right. Fabio?
I think one important thing from my standpoint in terms of financial stability risk assessment is not to become too complacent. Clearly, the financial system was resilient, particularly banks. The infrastructure and the framework that was put in place post-global financial crisis more than 10 years ago clearly has made the center of the financial system safer, more resilient. I'm talking about banks here. And so they're not been part of the problem at this point. But I think what I mean by not being too complacent is that it is true that there were a number of pressure points outside the banking sector in different segments of financial system. And in fact, central bank, only 10 years after the financial crisis, have to step in again and backstop, particularly in the United States, in Europe, in other countries. They have to backstop important segment of the financial system. So I think we need to learn the lesson that needs to be learned here and make sure that we keep in mind that the system worked because there was massive support in place. And so without that massive support, I think it remains unclear the extent to which the system would have worked smoothly in terms of functioning. And so whether there is a need to rethink a little bit the regulatory perimeter, particularly for non-bank financial institutions, and whether regulator and supervisor have the appropriate tool, macroprudential tools, to deal with the building vulnerabilities in that sector.
All right. Well, two very good points to end on. Don't pull policy support and also don't be complacent. But we hit on a number of topics today. We even squeezed in mention of Basel III, CLOs, so a very wide-ranging discussion. But again, Tobias Adrian, the financial counselor and director of the IMF's Monetary and Capital Markets Department, in addition to Fabio Natalucci, deputy director of the Monetary and Capital Markets Department. Thank you so much for joining us today.
Thanks, Brian. Very good to see you. Bye-bye.
Thanks, Brian.